What's up everyone, it's Caddy with Money Investing. So in this video, we are going to be talking about Silicon Valley Bank and everything that's going on with that company. We'll talk a little bit about the stock price, but in more detail, I want to go over what's going on with that company, with that bank, and how banks really operate and how this could actually create some type of volatility and some contagion in the market, and how this is a little bit more of a bigger problem because the Federal Reserve is kind of in a very similar situation with respect to SVB as well. So hope you guys enjoy this video and find it helpful. If you do, don't forget to subscribe and of course hit that like button. The link to our Discord and Patreon is going to be down below if you're interested in joining us, and that 16% annual discount is also available and down in the description below. And you're more than welcome to take advantage of that. We'd love to have you on board, and you'll get access to all the alerts and all the private videos as well. So this is how pretty much US stocks finished yesterday. We had Bank of America down 6.2%, Wells Fargo down 6%, SoFi, JP Morgan, Square, Credit Suisse, Citigroup. I mean, the list goes on and on. It was pretty brutal for a lot of banks. And then the European markets, which are currently open, they're also selling off, with the banking sector really underperforming. Deutsche Bank and some of the other banks in Europe and the UK selling off closer to 6-7% here, as this really becomes a bigger problem and a more of a systemic risk for the financial sector, for the banking industry at the moment. Now, this is on a nutshell how banks operate. So you may or may not have heard of this already, but what we call in the banking world is NIM, or NIM. That's the net interest margin. And it is a very, very simple concept, right? And the concept or the logic behind this is, as banks take in the deposits from customers, right? The customers could be individual people like you and I, as we deposit money in the bank, or companies deposit money in the bank. Those are all deposits the bank receives, and what they do is they turn around and they lend that money out. So the net interest margin is nothing but the difference between the rate at which they lend versus the rate at which they deposit, right? So in other words, when you and I deposit our money into the bank, right, we might get like 0.01%, right? 0.02%. That's like really, really low interest rates, right? Because if you go to a traditional bank, Bank of America or JP Morgan or, Morgan Stanley, Chase, whatever it is, you might get a very, very small interest rate on your deposit, right? It's not a coincidence. It's not a strategy. It is what's happening, right? And when these banks lend that money out, and they're lending our money out, they're charging 2%, 3%, 5%. And now, of course, in this current environment, they're charging much higher. So the net interest margin becomes a bigger and bigger problem. However, it also, as great of a situation it can be to collect money at 0.01% and to lend it out at 6-7% for the banks, it can also be counterintuitive, and it can also be counterproductive, so to speak, for banks, especially when there is a significant fight for liquidity in the market. And I'll explain what that means. So let's just quickly break down what really happened with SVB. So SVB is a Silicon Valley bank, right? So they've been around for about 40 years. They've been around for a long time. And, they're kind of owned by the SVB Financial Group, and it's one of the most important lenders when it comes to the startup space, right? So if you go to Silicon Valley, they are pretty popular. They are the ones that pretty much finance about 50% of all venture-backed companies in the US, and venture or private equity funds make up approximately 56% of the bank's global banking portfolio as of 2022. That's why it's such a big thing when SVB, a bank like Silicon Valley, that's pretty much financing all private equity deals, is going down the way it is. So their financial profile benefits from the abundance of client funds, as I explained earlier, which includes on-balance sheet deposits and also off-balance sheet client investments. So they collect deposits in a couple different ways, and its average client funds were at a high of $348 billion in the fourth quarter of 2022. Now, in 2021, when there was so much euphoria in the markets, there was so much greed, literally IPOs were flying left and right. Every company was going public. Silicon Valley Bank saw a massive influx of deposits, right? There was a lot of cash coming into the bank, which jumped from about $61 billion at the end of 2019 to over $190 billion as of 2021. So in just 2 years, they went from like 61 something billion dollars in deposits to over 190 billion. That's like, more than 3 times growth for the company in terms of deposits. So as deposits grew, right? As lots of startup companies, lots of IPOs, a lot of private equity companies are kind of depositing cash into their bank, and they're kind of handling a lot of deposits, a lot of client funds. Their loan book didn't grow fast enough, right? Their loan book didn't grow fast enough to generate the yield it wanted to see on this capital. And what does that mean? That simply means that as deposits grew for the company from 61 something billion dollars to about 190 billion, Silicon Valley Bank could not lend that money out fast enough, as there weren't any or little to no borrowers at that time in 2021. Most of the financing that was being done was through equity. Not a lot of companies needed debt at that time because, of course, we're going through that time period. And because of the rate of increase in deposits, they weren't able to grow their loan book, right? They weren't able to lend that money out to earn the return. So again, if you think about net interest margin, the bank doesn't want to sit on cash, right? The bank doesn't want to sit on capital. That's useless to them, right? If you deposit cash into a bank, they're not just going to hold on to it, right? They're going to turn around and they're going to lend that out, right? Because they need to make their own money, right? That's how they make money. That's their bread and butter, right? Net interest margin. So they're not just going to sit on the capital. So what does Silicon Valley Bank do? Well, they go after the US Treasuries. They go after the one product which has the longest duration, one of the longest duration, and that is mortgage-backed securities. So mortgage-backed securities, for those of you who don't know, are pretty much pool of investments that are putting together a lot of mortgages together. There's different ratings to it, and they were behind the great financial crisis of 07-08, and they were one of the reasons why the entire housing market came down the way it did back in 07-08, and we saw a significant crash because a lot of the mortgage-backed securities, the MBS products, were really, really shitty products. Excuse my language because it's straight from some of the movies that I've seen, but it was pretty bad when it comes to the different tiers of these mortgage-backed securities, and the borrowers underneath the mortgage-backed securities weren't very credit-worthy borrowers, and as they defaulted on their payments, the entire system pretty much failed. So Silicon Valley Bank, in this case, does buy mortgage-backed securities for their hold-to-maturity portfolio, and almost 97%, practically all of it, was with a maturity of over 10 plus years. So they bought them with a maturity of over 10 plus years with a weighted average yield of about 1.56%. So that's how much they were making by buying these mortgage-backed securities. So what you're really doing is when you're buying mortgage-backed securities, you are getting that yield because as investors are paying their mortgages, it comes to Silicon Valley Bank. They're collecting those yields as people are making their payments. However, with the raise in the federal funds rate, right? So as the interest rates are going higher, the value of the mortgage-backed securities plummeted, and that's what happens. And we talked about it in my other video. Because yields and prices move inversely, right? As prices go up, yields come down, and as yields go up, well, prices come down. So this is because investors can now purchase long duration risk-free bonds from the Fed at 2.5 times higher yield. And precisely with the rising US Fed interest rates, the value of the existing bonds with lower payouts fell in value. So the bonds that they were holding on, like MBS, on their books, pretty much dropped in value. Right? So they pretty much went down in their value. And as a result, they had to book losses for when they sold. And the second part of that argument, or the second part of this problem, is that not always banks have to sell at a loss. And the reason is because, look, Silicon Valley can hold on to this MBS products for 10 years, right? Because they bought them for 10 years maturities. So the plan was to hold them for 10 years. Why? Because they didn't expect a lot of liquidation all at the same time from their clients. So what ended up happening is that a lot of their clients, because of how interest rates have gone up, and you can actually get a higher interest rate bond from the Treasury, right? As we've already talked about on a more personal level, as you and I can get US Treasuries and get 5%, 5.2% from a 2-year Treasury note or like a 6-month T-bill, then why hold on to the S&P 500 and why deposit our money in the bank? Right? It's the same concept, but on a more company level, right? Why would companies invest in a bank when they can actually buy US Treasuries and get a higher rate of return risk-free, right? It's the same concept. It's a fight for liquidity at this point. And because of a lot of liquidation, Silicon Valley Bank didn't really have enough capital on hand to meet their client requirements, and as a result, they had to sell their mortgage-backed securities, which had already plummeted so much. So on the day that SVB yesterday was down 60%, it continued to fall in after-hours trading after they announced that it lost $1.8 billion in sales of securities to raise funds. And they also announced that they had to sell another $21 billion of their available for sale securities at a $1.8 billion loss, and we're raising another $2.25 billion in equity and debt. So they are going to be doing a stock sale to raise more cash in order to meet their client requirements. And this came as a surprise to investors, apparently, who were under the impression that Silicon Valley Bank had a lot of liquidity to avoid selling their at available for sale portfolio. But the portfolio was yielding an average of 1.79%, far below the 10-year yield of about 3.9, close to 4%. So startups withdrawing funds are on the lookout for other lenders where they can actually park their cash, while investors and financial firms are closely watching other banks that may also be affected in this contagion. It's unclear what will happen when the U.S. markets open, of course. And Bill Ackman also mentioned that the U.S. government should bail out to save Silicon Valley Bank. And what's the worst case scenario? The worst case scenario is for any bank is that it ends up with too little cash to operate, or suffers enough losses to erode its capital, prompting regulators to sell the bank to a stronger rival or wind it down. And that's really what happens. It's kind of like a double-edged sword, right? On one hand, you're buying MBS products or US Treasuries with the probability of them maturing, right? So you are pretty much getting that nice yield. But on the other hand, so on one hand, as the market price drops because the yields are going higher, that's number one. And number two, as a lot of people kind of withdraw their funds at the same time, the bank needs to kind of meet those liquidity requirements and meet those capital requirements. And as a result, they end up selling at a loss to meet their capital requirements on this side of the table. So that's really what ended up happening. And unfortunately, and to our surprise, the Federal Reserve is actually in a very similar situation. So let me just break down well, first of all, let me just break down this. This is a very quick chart of the actual mortgage-backed securities ETF. So it's kind of like a price ETF, and this is the mortgage rate. So you can see an inverse correlation, right? As yields go up, prices come down. So you can see how since November 21, this ETF pretty much dropped about 18%, as mortgage rates have pretty much pushed up about 152%. So again, as yields go higher, mortgage-backed securities prices come down, the ETF come down, and again, you can see that inverse correlation between these two. Now, this is the Fed's balance sheet as of March 9th, 2023. And as you can see over here, we've got U.S. Treasury securities sitting at $5.3 trillion, right? That's majority of it, so it's not a problem. However, we've also got mortgage-backed securities sitting right here, $2.6 trillion for the Federal Reserve. This is the Central Bank of the United States. If you scroll down a little bit, you'll notice that the maturities for these, so U.S. Treasury holdings, their maturities are coming up anywhere between 15 days to as much as 10 years, right? So 34 billion, 393 billion, 652 billion, 1.8 trillion, 1.4 trillion. So they're all over the place. They are maturing. They're liquid. If you take a look at mortgage-backed securities, though, right over here, they don't come up to maturities until about 1 year to 5 years. And even then, it's only $8 billion. Their real maturities begin after 5 years, 47 billion, and most of them mature in over 10 years, right over here. So over 10 years, $2.5 trillion. So the Federal Reserve is also holding on to mortgage-backed securities on their books that have heavy losses. And this right here is going to be an article that actually did prove it really well. So in Capitol Hill testimony this week, Federal Reserve Chairman Jerome Powell was asked if the central bank would consider selling its mortgage-backed securities at a loss, who estimated the Fed's current loss exposure is at roughly $500 billion, $500 billion. And Powell said the potential losses have played no role in the decision-making and that they are not considering right now. However, there was an analyst, Ankur Mehta from Citi Research, said that of course this may slow Fed's balance sheet runoff plans and prompt sales. Powell was pressed on. They said, and I quote, "We would assign a 60% probability for the Fed for selling in Q4 22 and first quarter 23, like in and around those times." So first quarter 23, this is where we are, and a 10% probability of the Fed selling after that, and 30% probability of them never selling their MBS product because they are holding on to a loss. Yet a big question still facing investors and lenders and anyone trying to navigate the still hot housing market is whether the Federal Reserve will start selling its trove of mortgage holdings to fortify its inflation fight. The central bank is so far trying to counter inflation by traditional means, which is raising the benchmark interest rates. And that's all they're doing right now. They're raising interest rates and they're only selling, or actively, not actively, but passively rolling over their U.S. Treasuries, right? This right here is what they're actually rolling over, is U.S. Treasuries. They're not touching the mortgage-backed securities. And the reason is because, well, first of all, they're holding on to $500 billion loss. And the second thing is it's going to absolutely demolish the housing market, because it's going to really creep up that interest rate. The mortgage rate is going to skyrocket as soon as the Federal Reserve starts actively selling their $2.5 trillion mortgage-backed securities that's just sitting on their balance sheet. So it's the only way, and Priya Mishra from TD Securities says, if they really want to sound like they're committed to price stability, selling MBS could be something to explore, but I don't think that they will. Instead, Mishra expects the Fed will first use higher rates and smaller balance sheet to keep a lid on housing market and avoiding a potential bubble burst, specifically by more aggressively raising its policy rate from the current range of 1.5 to 1.75%. Of course, it's an older article, but the bottom line is the Federal Reserve is actually in a very similar situation to what SVB is just going through. But the bigger problem is, of course, how this contagion kind of plays through into the other banks. And if we do see a flight to quality, in other words, more and more individual investors and companies kind of moving more towards US Treasuries as the yield is really high, their deposits are going to shrink. And as a result, they're going to have to find a way to find capital as well. So I hope you guys enjoyed this video and a quick update and a summary on the situation right now. Let me know your thoughts down in the comment section below. As always, happy investing, and I'll see you all in the next video.